Time value of money concepts, specifically future value and present value, are really important in a variety of accounting situations. These concepts and the related computational procedures are the subject of Chapter 6. Welcome, everybody. The concept time value of money means that money invested today will grow to a large dollar amount in the future. So, for example, $100 invested in a savings account at your local bank yielding 6% annually will grow to a whopping $106 in 1 year. So the difference between the $100 invested now, the present value of the investment, and its $106 future value represents the time value of money. Now, this concept has nothing to do with the worth or buying power of those dollars. Prices in our economy can change. If the inflation rate were higher than 6%, then the $106 you would have in the savings account actually would be worth less than the $100 you had a year earlier. The time value of money concept concerns only the growth in the dollar amount of money, ignoring inflation. Most accounting applications that incorporate the time value of money involve the concept of present value. So the valuation of leases, bonds, pension obligations, and certain notes receivable and payables are some of the examples. Interest is the rent paid for the use of money for some period of time. In dollar terms, it's the amount of money paid or received in excess of the amount of money borrowed or lent. So if you lend someone $100 today and you receive $106 in a year from now, your interest would be $6. Interest also can be expressed as a rate at which money will grow. In this case, that rate is 6%. It is this interest that gives money its time value. So simple interest is computed by multiplying an initial investment times both the applicable interest rate and the period of time for which the money is used. So, for example, simple interest earned each year on a $1,000 investment paying 10% is $100. The 1,000 times the 10%. While compound interest occurs when money remains invested for multiple periods. So it results in increasingly larger interest amounts for each period of the investment. The reason is that interest is then being generated not just on that initial investment amount, but also on the accumulated interest earned in the previous periods. So simple interest earned each year on a $1,000 investment paying 10% is $100, which is calculated here as $1,000 times 10. Cindy Johnson invested $1,000 in a savings account paying 10% compounded annually. How much interest will she earn each year, and what will be her investment balance after 3 years? Well, with compound interest at 10% annually, the $1,000 investment would grow to $1,331 at the end of the 3-year period. Now, if Cindy withdrew the interest earned each year, she would earn only $100 in interest each year, which is the amount of simple interest. But if the investment period had been 20 years, then 20 calculations would be needed. There are calculators in Excel and compound interest tables like those in the appendix of this textbook that really help make these calculations much easier. Most banks compound interest more frequently than once a year. Daily compounding is common for savings accounts. More rapid compounding has the effect of increasing the actual rate, which is called the effective rate, at which money grows per year. So it's important to note that interest is typically stated as an annual rate regardless of the length of the compounding period involved. In situations when the compounding interest is less than a year, the interest rate per compounding period is determined by dividing the annual rate by the number of periods. To understand, let's assume an annual rate of 12%. If it's compounded semi-annually, then the interest rate per compounding period is 6%, half of 12%. If the interest is compounded quarterly, then the interest rate per quarter would be 3%, which is 12 divided by 4. And if the interest is compounded monthly, then the interest rate per month will be 1%, which is basically 12% divided by 12 months. Now let's assume Cindy Johnson invested $1,000 in a savings account paying 10% interest, compounded twice a year. There are 2 6-month periods paying interest at 5%, the annual rate divided by 2 periods. How much interest will she earn the first year? And what will be her investment balance at the end of the year? Well, the $1,000 would grow by $102, the interest earned to $1,102.50, which is going to be $2.50 more than if interest were compounded only once a year. The effective annual interest rate, often referred to as the annual yield, is 10.25%, which is the $102.50 divided by $1,000 gives us the effective annual yield. So let's take a look at a concept question here. Jacob Lee invested $600 in a savings account, paying 8% interest, compounded twice a year. What will be his investment balance at the end of the year? Let's take a look. If we know it's being compounded twice a year, then that means he's receiving half of that, or 4% interest, every 6 months. So we start with an initial deposit. After 6 months, we have 4% times 600, or 24 bucks, that gets added to the principal initial balance. Then, the next 6 months, he receives interest on the $624. So 624 times that 4% gives him $25, which then gets added to his balance. Let's take a look at exercise 6.1. So determine the future value of the following single amount. Round factors to 5 decimal places and final answers to the nearest dollar amount. So in the first one, there was a $25,000 investment. The interest rate is 4%, and we have 14 number of periods. So, as you see here, what we can do is we look at the table that shows the interest rate of 4% and the number of periods of 14. You see the future value of a dollar factor is, you go to the 4%, 14 periods, and you see the factor 1.73168. Next, if we look at the interest rate of 7% for 15 periods, we go 7, go down here to 15, and you should see the 2.75903. I'm sorry, let me go back to this first one. So we're going to multiply the invested amount times the factor to give us our future value, which is what we will have at an interest rate of 4% after 14 periods. With number 2, the interest rate of 7% after 15 periods, we have the factor 2.75903 that gives us a future value here of $38,626. Now note that this is an easy way of doing it. We could take, like in the previous example, this $25,000 times 4%, then add it and to continue to do that 14 times to get this same figure. Number 3, an 8% interest rate times 16 periods would be a factor of 3.42594. We'll multiply that 20,000 times that factor to get the future value of the interest rate with the number of periods to be $68,519. And then last, an interest rate of 2% with the number of periods of 10 would mean 1.21889. We'd multiply that times our invested amount to give us that future value amount. So in this scenario, in Cindy's first example, in which $1,000 was invested for 3 years at 10% compounded annually, the $1,331 is referred to as the future value. A time diagram is a useful way to help visualize this relationship, with 0 indicating the date of the initial investment. The future value after 1 year can be calculated as 1,000 times 1.1, which equals $1,100. And after 3 years, the future value is 1,000 times 1.1 times 1.1 times 1.1, which is our $1,331. The future value after doing this, you can make it an easier way by looking it up on the table. We're going to use, in this case, table 1, the future value of $1, located at the end of the textbook. The table contains the future value of $1 invested for various periods of time, where N is the number of periods of time, and the various interest rates is I. Use this table to determine the future value of any invested amount simply by multiplying it by the table value at the intersection of the column where the rate and the number of periods come together. Now for another concept question here. Oliver Kim invests $5,000 in a bank account earning 8% interest, compounding annually. How much will he have in his account in 4 years? If the future value of $1 at 8% for 4 years is 1.36049, and our job is to round to the nearest dollar. So the way we would do that is take the 5,000 times that factor to give us $6,802. So the example used to illustrate future value shows that $1,000 invested today is equivalent to $1,100 received after 1 year, $1,210 received after 2 years, and $1,331 after 3 years, assuming a 10% interest compounded annually. So the $1,000 investment is the present value of a single sum of $1,331 to be received at the end of 3 years. It's also the present value of $1,210 to be received in 2 years, or the present value of the $1,100 to be received in 1 year. Remember that the future value of a present amount is the present amount times 1 plus I to the nth. Logically, that computation can be reversed to then find the present value of a future amount to be the future amount divided by 1 plus I to the nth. We substitute present value for 1, the invested amount in the future value formula. So, as with future value, these computations get simplified by using calculators, Excel, or present value tables. But Table 2, the present value of $1, provides the solutions of 1 divided by 1 plus I to the nth number of periods for various interest rates, I, and compounding periods for n. Now these amounts represent the present value of $1 to be received at the end of the different period. The table can be used to find the present value of any single amount to be received in the future by multiplying that amount by the value in the table that lies, again, at the intersection of the column for the appropriate rate and row for the number of compounding periods. So note that the further into the future the dollar is to be received, then of course the less valuable it's going to be today. This is the essence of the concept of the time value of money. Given a choice between 1,000 now or 1,000 3 years from now, of course, I hope you would choose to want that money now. In our earlier example, $1,000 now is equivalent to $1,331 in 3 years, assuming the time value of money is 10%. Graphically, the relationship between the present value and the future value can be viewed as shown here. While the calculation of future value of a single sum invested today requires the inclusion of compound interest, present value problems require the removal of compound interest. So the process of computing present value removes the $331 of interest earned over the 3-year period from the future value of $1,331, just as the process of computing future value adds the $331 of interest to the present value of $1,000 to arrive at the future value of $1,331. So the present value of calculations are incorporated into accounting valuation much more frequently than future value would be. So now let's take a look at a concept question for you. The Versatile Company purchased a delivery truck on February 1st, 2018. The agreement required Versatile to pay the purchase price of $44,000 on February 1st, 2019. Assuming an 8% rate of interest, to calculate the price of the truck, Versatile would multiply $44,000 by the A, future value of an ordinary annuity of $1, B, the present value of $1, C, the present value of an ordinary annuity of 1, or D, the future value of 1. So, basically, the correct answer is the present value, because the calculation is for the present value today of the $44,000 to be paid 1 year from now. So let's look at exercise 6.3. We're going to determine the present value of the following single amounts. So again, the future of $2,200 here at an interest rate of 6% over 11 periods. What's the present value? Same with 2, 3, and 4. And we are going to use this present value table in order to compute and find the factor that gives us the present value. So, the $2,200 future, the interest rate of 6% over 11 periods, 6% over 11 periods, we'd use this factor of 0.52679, would calculate the present value of 1159. Next, 1,200 at a 7% rate for 13 periods. Again, 7% rate, 13 periods, 0.41496. The 1,200 times that factor would be a present value today of $498. Next, the interest rate of 10% for 21 years. 10%, 21 years would be 0.13513. We'd calculate a present value of $351. Next, the future amount is $5,100. The interest rate is 20%, 6 periods. That would be the 0.33490. That would calculate to be a present value of that amount would be $1,708. So there are 4 variables in the process of adjusting single cash flow amounts for the time value of money. It's the present value, the future value, the number of compounding periods, which would be N, and then the interest rate. If you know any 3 of these, the 4th can be determined. So suppose a friend asks to borrow $500 today and promises to repay you $605 2 years from now. What is the annual interest rate you would be agreeing to? The unknown variable is the interest rate. So, the interest rate is the rate that will provide a present value of $500 when determining the present value of the $605 to be received in 2 years. Rearranging algebraically, we find that the present value table factor is 0.82645. When you consult the present value table, which is table 2, you search row 2 for the number of periods is 2 for this value, and you find it in the 10% interest column. So the effective interest rate is then 10%. You want to invest $10,000 today to accumulate $16,000 for graduate school. If you can invest at an interest rate of 10%, compounded annually, how many years will it take to accumulate the required amount? Well, the number of years is the value of N that will provide a present value of $10,000 when finding the present value of $16,000 at the rate of 10%. Rearranging algebraically, we find the present value table factor is 0.625. When you consult the present value table, you search the 10% column where interest is 10 for this value, and you find 0.62092 in row 5. So it would take approximately 5 years to accumulate $16,000 in the situation described. Many assets and most liabilities are monetary in nature. Monetary assets include money and claims to receive money, the amount of which is fixed or determinable. Examples of monetary assets include cash and most receivables. Most liabilities are monetary because many of these liabilities are obligations to pay amounts of cash, which is, again, fixed or determinable. If you borrow money from a bank and sign a note payable, the amount of cash to be repaid to the bank is fixed. So monetary receivables and payables are valued based on the fixed amount of cash to be received or paid in the future with proper reflection of the time value of money. So, in other words, we value most receivables and payables at the present value of future cash flows, reflecting an appropriate time value of money. Stridewell Wholesale Company sold a large order of shoes to Harmon Sporting Goods for $50,000. Stridewell agreed to accept a note in payment for the shoes, requiring payment of $50,000 in 1 year plus interest at 10%. Should Stridewell value the note receivable and corresponding sales revenue earned? Or how should it? How should Harmon value the note payable and the corresponding inventory that was purchased? So as long as the interest rate explicitly stated in the agreement properly reflects the time value of money, then the answer is going to be $50,000, the face value of the note. It's important to note here that this amount is always also equal to the present value of future cash flows at 10%. Future cash flows equal $55,000, which is the $50,000 note payable plus the $5,000 of interest. So the $55,000 future value times the 0.90909 equals $55,000 present value. You see, this equation form we can solve here for the present value, where the present value of 1, N is 1 period, and the I is 10%. So by calculating the present value of $55,000 to be received in 1 year, the interest of $5,000 is removed from the future value, resulting in the appropriate note receivable or sales revenue value of $50,000 for Stridewell and a $50,000 note payable or inventory value for Harmon. While most notes, loans, and mortgages explicitly state an interest rate that will properly reflect the time value of money, there can be exceptions. So consider this slide where even though the agreement states a non-interest-bearing note, the $60,500 does in fact include interest for the 2-year period of the loan. So to find the present value of the note, which is the price of the shoes, we need to know either the cash price of the shoes or the appropriate interest rate for a transaction like this one. Let's say the market rate is 10%. How should Stridewell and Harmon value the note receivable or payable and corresponding sales revenue or inventory? Even though the agreement states a non-interest-bearing note, the $60,500 does include the interest for the 2-year period of the loan. We need to remove the interest portion of the $60,500 to determine the portion that represents the sales price of the shoes. We do this by computing the present value. Again, using the present value of a dollar table, $60,500 future value times 0.82645 equals $50,000, the present value. So the 0.82645 is the present value factor of a dollar at 10%, column in row 2. Both the note receivable for Stridewell and the note payable for Harmon initially will be valued at $50,000. The difference of $10,500, which is the $60,500 minus the $50, represents interest revenue or interest expense to be recognized over the life of the note. So here we have another concept question. Turpentine Distillery is considering investing in a 2-year project. The company's required rate of return is 10%. The present value of a dollar for 1 period is 10%, is the 0.909, and 0.826 for 2 periods at 10%. The project is expected to create cash flows net of taxes of $240,000 in the first year and $300,000 in the second year. The distillery should invest in the project if the project's cost is less than or equal to $540,000, $490,860, $465,960, or $446,040. Well, basically, we'll calculate that by the $218,000, which is basically the $240,000, the cash flows net of taxes, $240,000 in the first year and $300,000 in the second year. So it gives us the present value of $1 for one period. That's 0.909 is what we would create the present value of those future dollars. And then in year 2, the $300,000 would be the future amount by the factor of 0.826 gives us our present value for both periods. So the correct answer here would be $465,000. Present value measurement has long been integrated with accounting valuation and is specifically addressed in several accounting standards. So because of its increased importance, the FASB issued Statement of Financial Accounting Concept number 7, using cash flow information and present value in accounting measurements. This statement provides a framework for using future cash flows as the basis for accounting measurement and asserts that the object in valuing an asset or liability using present value is to approximate the fair value of that asset or liability. Key to that objective is determining the present value of future cash flows associated with the asset or liability, taking into account any uncertainty concerning the amounts and timing of the cash flows. Although future cash flows in many instances are contractual and certain, the amounts and timing of cash flows are less certain in other situations. So traditionally, the way uncertainty has been considered in present value calculations has been by finding the present value of the best estimated future cash flows, applying an interest rate that's been adjusted to reflect the uncertainty of risk of those cash flows. So with the approach described by SFAC number 7, the adjustment for uncertainty or risk of cash flows is applied to the cash flows, not to the interest rate. So this new expected cash flow approach incorporates specific probabilities of cash flows into the analysis. Let's look at this. The expected cash flow is calculated as $220 million. If the company's risk-free rate of return, rate of interest is 5%, Dalton will report a liability of $172,376,600, the present value of the expected cash outflow. The interest rate used to determine present value when applying the expected cash flow approach should be the company's risk-free rate of interest. Uncertainty is incorporated into the determination of the probability-weighted expected cash flows. In the traditional approach, uncertainty is incorporated into the risk-adjusted interest rate. So here's another concept question we're going to take a look at. Willie Wynn Track Shoes used the expected cash flow approach to determine the present value of a future obligation to be paid to Betty Will Company in 4 years. Estimated future payment possibilities were as follows. A possible payment of $100 million had a 20% probability. A possible payment of $140 million had a 40% probability. And a possible payment of $180 million had a 40% probability. So the risk-free interest rate is 5%. The present value of $1 in 4 periods at 5% is 0.82270. what is the estimated present value of the future obligation? So basically what we'll do here is we'll take our probabilities. 100 million at 20% is 20 million. 140 at 40%, 56. 180 million at 40%, 72. So we total those to come up with a $148 million payment times the present value factor gives us the 0.82270. That calculates out for a present value of 121.76 million, rounded is 122 million is the estimated present value of a potentially future obligation. Now let's look at exercise 6.6. For each of these following situations involving single amounts, solve for the unknown. Assume the interest is compounded annually. So in the first problem we have to, our unknown is the present value. In the second problem, the unknown is the interest rate. In the third, it's the periods. The fourth, it's the interest rate. And the fifth, it's the future value. Again, if we have three of these, we are able to figure out the fourth factor. Anyway, sorry. It's late. My mind is tired. So, in this scenario, we know the future value. We know the interest rate is 4% at 7 periods. So we're going to go to the table to find the factor, 7 periods at 4%, to give us the 0.75992, right where the intersection is. So we can calculate the present value by that factor times 30,400. Gives us the present value amount. Next, we have the, we know the present value, we know the future value, and based on that, we can calculate the factor, where the number of periods is 10, so we can calculate the interest rate in that scenario at 8%. 8% here, where the number of periods of 10 give us our factor. Next, we know the present value and we know the future value, and our interest rate is at 12. So we are given the factor of 0.25669, and as a result of that, we can calculate the number of periods is 12. Again, if we know the present value and we know the future value, we can then create the factor when the number of periods is 9 and gives us the 8% interest rate. Last, we know the present value, we know the interest rate, and the number of periods. So in order to get the future value, we find the factor of the future value of $1, which is just table 1, 2% with 21 periods, and that 1.51567 times our present value will then give us the future value amount. The previous examples involved the receipt or payment of a single future amount. Financial instruments frequently involve multiple receipts or payments of cash. If the same amount is to be received or paid each period, this series of cash flows is referred to as an annuity. The common annuity encountered in practice is a loan on which periodic interest is paid in equal amounts. For example, bonds typically pay interest semi-annually, in an amount determined by multiplying a stated rate by a fixed principal amount. Some loans and most leases are paid in equal installments during a specified period of time. An agreement that creates an annuity can produce either an ordinary annuity or an annuity due, which we sometimes call an annuity in advance situation. So an ordinary annuity is where the first cash flow, the receipt or the payment of this ordinary annuity, is made by one compounding period after the date on which the agreement begins. So the final cash flow takes place on the last day covered by the agreement. So like an installment note payable dated on December 31st, 2018 might require the debtor to make 3 equal annual payments, with the first payment due on December 31st, 2019, and then the last one due on December 31st, 2021. So this time diagram illustrates what is called an ordinary annuity. Now, an annuity due is where the first payment of an annuity due is made on the first day of the agreement, and the last payment is made one period before the end of the agreement. So an example here is like a 3-year lease of a building that begins on December 31st and ends on December 31st, 2021, but is going to require the first year's lease payment in advance on December 31st, 2018. Now the third and last payment would take place on December 31st, 2020, the beginning of the third year of the lease. So as you see, this diagram illustrates this situation. So here we have a concept question. If you have a set of present value tables, an annual interest rate, the dollar amount of equal payments made, and the number of semi-annual payments, what other information do you need to calculate the present value of a series of payments? Would it be the timing of the payments, whether they are in the beginning or end of the period? The future value of the annuity? No other information is needed, or the rate of inflation. I sure hope you got this one right. If payments are made at the end of the period, it's an ordinary annuity. But if they're made at the beginning of the period, it's called an annuity due. Here's another one. Just an investor wants to calculate how much money he needs to deposit today into a savings account that earns 4% in order to be able to withdraw $6,000 at the end of each of the next 5 years. He should use which present value concept? Well, the present value of $1 for 5 periods, the present value of an annuity due of $1 for 5 periods, or the present value of an ordinary annuity of $1 for 5 periods, or the future value of $1 for 5 periods. So what is it we're trying to calculate? We're trying to calculate the present value of an ordinary annuity of $1 for 5 periods. He's going to want to be able to withdraw that at the end of each of the next 5 years. So we know it's an ordinary annuity. The calculation we need is how much does he need to deposit today so he can receive that much at the end of each year over the next periods. Here's another one. The Not Worth Getting Consulting Company purchased a machine for $15,000 down and $500 a month payable at the end of each of the next 36 months. How would the company calculate the cash price of the machine, assuming the annual interest rate is known? So would this be $15,000 plus the present value of $18,000, which is the $500 a month for 36 months? Or $15,000 plus the present value of an annuity due of $500 for 36 periods, $33,000? or $15,000 plus the present value of an ordinary annuity of $500 for 36 periods. Remember, this $500 is going to be paid at the end of the next 36 months. So the $15,000 is paid down right away. So the correct answer here would be D, because it's the present value of an ordinary annuity of $500 for 36 periods. Remember, the $500 gets paid at the end of each of the 36 months, not at the beginning. If it's at the beginning, it would be an annuity due. At the end, it's an ordinary annuity. So Rita Grant wants to accumulate a sum of money to pay for graduate school. Rather than investing a single amount today that will grow to a future value, she decides to invest $10,000 a year over the next 3 years in a savings account, paying 10% interest compounded annually. She decides to make the first payments to the bank 1 year from today. So using the future value of $1 factors from Table 1, we calculate the future value of this annuity by calculating the future value of each of the individual payments. From the time diagram, we see that the first payment has 2 compounding periods to earn interest. The factor used, 1.21, is the future value of $1 invested for 2 periods at 10%. The second payment has 1 compounding period, and the last payment does not earn any interest because it is invested on the last day of the 3-year annuity period. Therefore, the factor used there is just 1. So this slide shows that it's possible to calculate the future value of an annuity by separately calculating the future value of each payment and then adding these payments together. Fortunately, we don't have to do that because Table 3, which is the future value of an ordinary annuity, simplifies the computation by summing the individual future values of 1 factors for various factors related to period and interest. So, the future value of $1 at the end of each of 3 periods invested at 10% is shown in Table 3 here to be 3.31. We can simply multiply this factor by $10,000 to derive the future value of our ordinary annuity. Now, this slide gives us an illustration of an annuity due. So Rita wants to accumulate a sum of money to pay for graduate school, but rather than investing a single amount today that will grow to a future, she decides to invest $10,000 a year over the next 3 years in a savings account, paying 10% interest compounded annually. She decides to make the first payment to the bank immediately. How much will Rita have available in her account at the end of 3 years? So as you see here, this time diagram depicts the situation. 0 is the start of the first period. Now the future value can be found by separately calculating the future value of each of the 3 payments and then summing those individual future values. Or this same future value can be found by using this amazing table, future value of an annuity due, factor from Table 5. Of course, if unequal amounts are invested each year, we can't solve the problem using the annuity tables. So the future value of each payment would have to be calculated separately there. Here is another check your work. In this example, the Stench Fertilizer Corporation wants to accumulate $8 million for plant expansion. The funds are needed on January 1st of 2023. Stinge intends to make 5 equal annual deposits in a fund that will earn interest at 7% compounded annually. The first deposit is to be made on January 1st, 2018. Present value and future value facts are as follows. We've got the future value of an ordinary annuity of $1 at 7% for 5 periods. The future value of an annuity due of $1 at 7% for 5 periods. The present value of $1 at 7% for 5 periods. And then the present value of an ordinary annuity of $1 at 7% for 5 periods. So if the goal is to want to accumulate this $8 million for plant, and they're needed January of 2023, and he wants to make 5 equal payments, and the first payment is going to happen on January 18th, then we need to determine which of the tables are we going to use. So as you see here, we are going to use the table, the future value of an annuity due. We've got $8,000 that we want to receive, but the future value of an annuity due means when the payments are going to be paid. We're going to pay them right away. Therefore, if the funds are needed on January 1st, and we're going to make our first deposit on January 1st of 2018, it allows us to know the annuity due means the first payment happens at the very beginning of the month right away. If we take the $8 million times the 6.15, then that means our annual deposit each year would be $1,300,813. Here's another one. I.R. Wright plans to make quarterly deposits of $200 for 5 years into a savings account. The first deposit will be made immediately. The savings account pays interest at an annual rate of 8% compounded quarterly. How much will Wright have accumulated in the savings account at the end of the 5-year period? Well, it's letting us know the payments occur at the beginning of the period. And so we would need to calculate the future value of an annuity due because the payments happen right away. Therefore, we would show here the $200 times the 24.2974, and the reason we would calculate it 2% for 20 periods is because if the interest is paid quarterly, compounded quarterly, we're going to have 20 periods at 2% interest, which gives us the 24.294. So 200 bucks times the correct factor means at the end of this time we will have $4,859 available. U.B. Wong plans to make quarterly deposits of $200 for 5 years into a savings account. The deposits will be made at the end of each quarter. The savings account pays interest at an annual rate of 8% compounded quarterly. How much will Wong have accumulated in the savings account at the end of the 5-year period? Well, we know this is an ordinary annuity because the payments are made at the end of the month. So we're going to take the future value of an ordinary annuity of 1 at 2% for 20 periods. Same as the previous example. Since interest gets compounded quarterly, we are going to have 20 periods at 2% interest a period. Next, let's look at 6.7. Gold Rose Production plans to make 4 annual deposits of $4,000 each to a special building fund. The fund's assets will be invested in mortgage instruments expected to pay interest at 12% on the fund's balance. Using the appropriate annuity table, determine the amount that will be accumulated in the fund on December 31st, year 4, under each of the following situations. So first, the first deposit's made on December 31st, year 1, and interest is compounded annually. And then we've got situation 2, the first deposit's made on December 31st, year 0. So again, that's an annuity due. Number 3, the first deposit's made on December 31st, year 0. That's an annuity due. And then the number 4, the first deposit's made on December 31st, year 0. Interest is compounded annually, and interest earned is withdrawn at the end of each year. So let's look. When the first deposit is made on December 31st, year 1, and interest is compounded annually, you'll see this is an ordinary annuity because it's paid at the end of the period. So, as you see here, if it's compounded annually, then what we're going to look at is the annuity amount of $4,000, and we'll look at the future value of 12% for 4 periods, or 4.7793, to come up with the future value of an ordinary annuity would be $19,117. Now the next one, if the deposit is made on December 31st, year 0, then that means it's an annuity due. So the annuity due means we pay it at the beginning of the period. With an annuity due, we are going to show where the interest rate is 12%, number of periods 4, gives us our factor of 5.3528, right at that intersection. The total would be $21,411. Next, when the first deposit is paid at the very beginning, year 0, an annuity due, but the difference here is the interest is compounded quarterly. So instead of looking at 4 periods, we're going to look here at 16 periods, and instead of a 12% interest rate, we're going to be looking at a 3% interest rate here. So as you see here, if in the first scenario, the first deposit of $4,000, if we've got it compounding quarterly, it's where I is 3%, the interest rate, and the number of periods is going to be 16. In the second deposit, we would look at interest rate is 3%, number of periods would be 12, which gives us the factor of 1.42576. Next, the third deposit and the fourth deposit. So basically, interest is getting compounded, is being compounded quarterly. So there you see the future value of those various different payments. The total here is $21,691. Last, the first deposit is made on December 31st, year 0. Interest is compounded annually, and interest earned is withdrawn at the end of each year. Well, in this scenario, we've got 4 payments, which we need $16,000. There is no interest that's going to be compounded because we're taking it out. Therefore, all we've got are the investments to come up with our figure. We're going to stop here, and I'm going to finish out lecture 1 or part 1. We'll move on to the next portion of the chapter.